Hey traders, welcome to Charts and Coffee. Happy Thursday, everybody. We're taking a look at the rather large reaction at 8:30 to the unemployment claims that were released. And you can see if you take a peek at the intraday charts, take a look at a 5-minute, you'll see that reaction right here. It's the Dow. You'll see the reaction right there at 8:30. We're coming back down a little bit after that initial move. And this is now, again, we're seeing data that is better than expected. So right now it does seem with rate cuts, at least for the next 3 meetings set, it does seem that now in terms of reaction, market participants want to see better than expected data, or at least solid data, as opposed to data that is a miss, which would, in the past, the last 6-7 months, that's generally been a reaction to tell the Federal Reserve to get on the ball. Now that it's discounted, that they finally got the hint, now you want to see good data. And it seems now with that unemployment claims better than expected, lower than expected, that's a positive reaction. That's not been the way it's been for most of the year. So we are in good data is bullish mode, at least for now. We saw the same thing. We saw the same reaction in non-farm payroll, where a miss wasn't bullish to indices or bonds. It was actually bearish. So this is now a second jobs number that is kind of back out of the rabbit hole. And so anyway, that's where we are. We're also above the previous session close. So yesterday's previous session close and the Dow was 38,784. Obviously, we're trading above 39,000 right now on the YM. ES, very similar look, right? Almost identical. It's actually not only above the previous session close, but we're above the previous session open on the ES. So moving and grooving to the upside. And, by the way, what happens pre-market isn't necessarily, as we know, what we're going to get for the remainder of the session, but to start the session, or at least in 28 minutes, we'll see. For now, we are sitting above, and not by a small margin. I mean, the NASDAQ is 1.75% above the previous session close. So these lines in the sand are really important. What other lines in the sand can we look at? We can look at the range for the week. We can look at different indicators by way of, I look at the candles that I've got on my 5-minute chart. These are bullish green candles. These are not your traditional Japanese candlesticks where they're green and red or hollow or shaded out. These measure not just momentum and trend, but also participation. We're going to be inheriting an uptrend on the Dow. It looks like the S&P and the NAS, or at least that's where we sit right now at 3 minutes past the hour, post unemployment claims. Everything but the Russell is actually intraday 5-minute in an uptrend. All right, so let's go ahead and take a look. Now, I will say the reaction in bonds, although the long bond auction is today at 101. We had the 10-year already. We've got the long bond auction today. So this is a little bit of an unusual reaction where the yields are actually higher. And that's what when TLT moves lower, when the ZB futures move lower, that's actually higher yields, marginally higher. But this is a look at slightly higher yields in reaction to that better than expected number. A little odd, but for now, I'll just see what happens between now and 1:01 p.m. Eastern. We do have that bond auction coming up. So I would steer clear of bonds for now. But what about gold? Gold does oftentimes key off a lot of what happens in the bond market. And if you take a look at where gold is this morning, gold is up. Gold is up from yesterday's close by almost a full percent. We love it. One of the open positions that we have in the master, I was looking at 3 things. And if you've been following Charts and Coffee or following the free videos or following me in the rooms, you know that we've been bullish gold, GDX, but not GDX specifically, but rather the heaviest weighted stock by a landslide in GDX, which is NEM, Newmont Mining. So we've got a long position in Newmont Mining that we built as we pushed. And this is really cool data, gang. If you've never thought about, I think most of us are really familiar with using moving averages as dynamic support and resistance, using horizontal support resistance, those folks who draw trend lines. things like that. But there are levels of support and resistance that are actually stealthy and oftentimes more powerful. And those are levels of volume and volatility. And you can definitely see yesterday, Newmont Mining really pushed the extreme to the downside of the first standard deviation of the historical volatility we see. So what we study is the 68% probability. So nothing can account for 100%, right? If we just start there, nothing can say this is going to hold 100% of the time, nothing. But we have found zones that hold the 68% probability of movement. And sometimes when we exceed that, we go into that rare air of the 32%. There are often, especially in uptrends, opportunities in that. So we're long Newmont Mining in terms of, probably one of the best ways to take advantage of gold and not necessarily quite yet GDX. These are Newmont Mining positions that we've built down from this area here. We're going to open a little bit higher today, at least above the previous session close. It looks like around 47. So I'll take it. Okay, so moving on to what's been happening with crude oil and copper. All right, crude remains very heavy. And I'll tell you, this is not necessarily a bad thing, because one of the things that copper mostly and crude have been indicating is that inflation is falling. Copper is oftentimes a commodity futures contract, HG futures, that tend to mimic what inflation is doing. And I don't want to say forecast or lead. I hate that verbiage. But, obviously the rollover in July is telling us something. A, copper's in a downtrend. And B, that might be indicative of the inflation dropping that the Federal Reserve is wanting to see. So that's actually fine. It just does mean, however, that we have to be very cautious about buys in energy stocks and certainly steer clear of metals and mining like XME, because copper is going to be that indicator to the weakness in that sector. All right, so let's see. We have any questions in the rooms? Good morning to our essential room as well. Let's see. The positive reaction. Yeah, I'd say Nomo. The reason that, if I were to look at why we're doing that, again, why is kind of a secondary thing. It's always sort of, it is what it is, right? But Nomo, I would say, since we were always, I say we collectively as traders and investors, we're always on a sort of razor's edge as to whether or not, as early in this year, we could have cut in March or May. Didn't happen. Could we cut in July? Didn't happen. So now it's fully discounted as of the non-farm payroll that we got last month. It's fully discounted that they're going to cut. So once we are 100% certain, and we are, that the cutting cycle, the dovish cycle, is going to commence, now it's really important that the economy actually look healthy. So that's a big reason why those two forces coming together. All right, first question is from our YouTube channel. All right, John asked, thoughts on EA based on the daily? Sure, thank you for the time frame and the symbol. EA has actually been a pretty decent relative performer within its sector. And while it doesn't have consistency in the green candles, it certainly is stair-stepping. I mean, literally, John, take a look at, and everyone, take a look at those Darvis levels. These are automated support and resistance levels. I call them Darvis. They're really Darvis 2.0. It's sort of a reimagining of, if Darvis were trading today, his Darvis boxes wouldn't be solely reliant on 52-week highs, which is what the traditional Darvis is. But in terms of the pattern that he looked for at 52-week highs, part of it is, well, what if we found that pattern anywhere, not just at those 52-week highs? And that's what this is. So this is not a classic Darvis. This is a Darvis 2.0. I like to pay homage to those who inspired, hey, how else could we take a really cool idea that's been relevant for over, at this point, 70 years, and say, look, we need to modernize this because the behavior of the markets are different. The influences on the market are different. And look at how it's been stair-stepping now since the beginning of June. So any one of those Darvis levels, John, would be reasonable for EA. I would just keep an eye on the liquidity. It can be a little spotty on the options chain. So keep an eye on that OI. But yeah, absolutely. I'd keep an eye on it. Nice uptrend on the daily as well. All right. Let's see here. AMC asks, can I share which brokerage company I would use? I would like to get the indicator so I can recommend. Oh, so AMC, you have a couple of choices. One of the things we do in the Sector Secrets Mastery, and this question is about brokerage companies, is look, trade with whomever you want. I'm not here to tell you who to trade with. I can tell you what some of the popular options are. TOS is probably still the most popular, followed by, I'd say, Tasty and Interactive Brokers. Tradier is getting a lot more traction, I believe. There's a number of them. I'm not picking out my favorite. These are just the ones that I've been seeing our members either use or like, test. But I'd say for the most part, Thinkorswim, Tastyworks, and Interactive Brokers. So Tasty, IBKR, and TOS. And then what the cool thing is, you don't have to be with any specific broker to trade with me, because all of our indicators are also on a broker agnostic platform. Here we go, called TradingView. So this way, if you're not in the US and you don't have access to, say, TOS, right, which is again probably the most popularly supported platform here at Simpler. One of the things that we did years and years and years ago, I've been using TradingView for almost a decade now, is we made sure that we put all of our indicators on this platform as well. That way, no matter where you are, no matter what kind of platform you're on, Mac, Windows, iOS, Windows, you can use this. It's a web-based platform. It's a very powerful platform, and you can use this coupled with whichever broker you want. So no, I do not support all brokerages. So my indicators work on TOS and they work on TradingView. But if you use TradingView, at this point, you've got broker agnostic charting platform. You're not going to trade through this. You'll chart through this, and then you can trade through whomever you'd like. All right. Next up is Pat asks, can I explain what happens with the 2-year and 10-year bonds invert and finally normalize? Pat, I will tell you that is probably the most, and thank you for the question, because I think a lot of folks obsess on this. It really doesn't matter. It really doesn't. For whatever reason, it becomes discussed a lot. When people look at, say, the shorter end of the yield curve versus, say, the 10-year. So here's a 10-year right now. And you can pull up TNX, I believe, to pull up the actual yield number as opposed to the chart of the 10-year bond, 10-year note. But it's probably one of the most overhyped indicators. And yet, look, remember, on financial television, and frankly, a lot of trading analysts, they love to talk about this kind of stuff. Here's the problem. It really isn't something that's relevant to traders. It just isn't. The overall reaction to that inversion, there's some good historical data that the first inversion is not the most important. It's the re-inversion that's important. And when they normalize, people will take from that what they will. But what I'll tell you is it's really not been a good trading indicator. It actually is a very poor indicator of where the trends on the charts in terms of the broader averages are going to be. And therefore, I really just don't pay any attention to it. Because remember, it's not enough for us to have a general feel for what's going on in the market, right? I think market internals are oftentimes where traders say, well, the tick is doing this, the trend is doing that, or the advanced decline. But the truth of the matter is we're going to find much better trades when we just look at the chart that we want to trade and find the relative outperformers. So there's a lot of things out there that are popularly used and discussed. But I have found through, I heard those things early on in my career too, until I finally realized, oh, they really don't help me personally with timing. And so I just kind of discard that and dismiss it, because it really doesn't help me with the timing on the trades. It doesn't help me determine when to leave. Like, for example, what we've been doing in the Masters, we're not touching tech with a 10-foot pole, right? I don't need a yield curve inversion or normalization to know that. It's been heavy. It's not been the leading index. None of the sectors within it are the strength indicators. So, that's why we've been focusing on things like utilities and staples and healthcare. I mentioned new mining. And so that's where I kind of land on that. It's interesting information, I guess, but it's never really helped me with my trading, in terms of timing, which is what trading is. It's just a lot of timing. All right. So next up, and don't be afraid to dismiss a lot of the dogma out there, right? Unless you find it works for you, it doesn't mean anything if someone else is talking about it. A lot of folks just talk to talk, especially in the financial arena, right? As one of my mentors used to say, he goes, Rog, stock market trading is astrology for men. I'm not picking on dudes. It's astrology for everybody. But that's what he used to tell me. And he told me that, 30 years ago. And so I think a lot of folks just like all this ancillary information where it may not really help. It may not really help. By the way, we need to take a look at the 6J. What is affecting equities? And so much of the panic that we saw in that carry trade unwind was predicated on the July 31st second hike from the Bank of Japan, followed by, and this is so, it's as if there was this grenade sitting there, carry, and someone pulled the pin when non-farm payrolls came out. Because you'll notice we didn't move like this on the 31st in terms of the unwind and the broader averages. The extreme came when the non-farm payroll came out in the US, and that allowed the yen to just accelerate past the weakening US dollar. Well, here we see that full-on panic. And by the way, that was when the VIX hit 4.2 million or whatever that high was. It was about 37 on the VIX futures. You can see we're coming back from that. So the hype and the concern, at least for now, of an immediate carry trade unwind 2.0 has been largely over discounted. But hey, fear keeps people tuned in. So, it kind of reminded me of, I've been living in Florida a long time. And one of the things that we've come to hate in Florida and sort of oddly love is the Weather Channel when a storm is coming, because we know there's a lot of exaggeration. Anyone ever see that video of the newscaster kind of pushing against the wind as if he was in this terrible, terrible weather, as he's broadcasting the storm that's coming through, and then two kids are just walking in board shorts, normal as can be, in the background. So the Weather Channel and financial media have a lot in common. If there's something they can overhype to keep you tuned in, they will. They absolutely will. And I think that, we had a hurricane, we had a storm, and everyone tuned in. And, we're only going to tune in as long as the storm's spinning and they can show branches falling, right? So 6J is coming down, and that should generally be at least one less concern for the overall averages. So I'll definitely be sticking with a lot of the defensives. They don't look pretty, but they have been pretty resilient. And let's see, we got a question on Procter & Gamble. Yeah, Procter & Gamble. Actually, let's do it this way. Let's do it this way. Let's open up Procter & Gamble, and I'll show you what we're looking at here. So this is the XLP. This is this consumer staples. Procter & Gamble is the number one weighted stock. There are a number of names that look really good here. Frankly, none better than Coke, followed by, I'd say, Philip Morris and Altria. Keep an eye on those. I would leave Procter & Gamble alone for now. It's not a no. It's just that if I have a ranking of things that I am interested in, it's going to be largely Coke, Pepsi, Philip Morris, and Altria, followed by, I'd say, Mondelez, Colgate, and then, yes, PG, and probably in that order. So Colgate looks a little bit better than Mondelez. So that's the way I would focus on what's happening in staples. And if I'm looking at where the trends are, let's focus there first. And then the second tier of interest would come via those bullish, choppy markets like Mondelez, like Colgate. All right. That is a wrap, gang. As always, thank you so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. Be good to each other.